So Dave Ramsey last week posted on social media his how to invest your money guidelines. And I will say this seemed to take the advisor world by storm. There were lots of interesting comments on LinkedIn and other social media sites where advisors tend to gather. I will say that the strategy that he posted, I understand where it comes from. It was also very, what I would call, dummy proof. It was kind of hard to screw it up. And honestly, have you listened to a Dave Ramsey show? I mean, there's some people who call in that you're just kind of like, really? So maybe, we shouldn't have taken this as seriously as some people did, and just kind of go, well, he's talking to the masses, right? So if you're talking to the masses, you probably have to have a pretty foolproof investment strategy that can work for everyone. I mean, honestly, I don't think most of us probably even watching this video right now would be the target audience for Dave Ramsey and what they produce. But anyway, I don't want to make to be too critical of Dave. I mean, you think about what he's done as a entrepreneur, what he's done as a motivator or an entertainer on his radio shows and his the stuff that he does in video as well. He's changed people's lives. I mean, he's enabled people who were just ridden with debt to be able to start growing wealth. And he's created wealth for himself. I believe the last I heard, his company was generating billions and billions of dollars a year in revenue, and lives a lifestyle that, quite honestly, most advisors would envy. Even some of the best in our business, or biggest, I should say, in our business, don't live the lifestyle of the Ramsey family. So kudos for him for being a successful entrepreneur. I do kind of picture Dave in dad jeans, though, sitting by the fire, reading his latest edition of Kiplinger magazine that he just got in the mail, and trying to find the latest growth fund to invest in. So I do kind of see the investment strategy is a little old school and not very well thought out in some areas. But so anyway, all joking aside, let's kind of skip right to what he had. I mean, basically, he says invest in mutual funds. So Dave, you lose me right there. Mutual funds have been losing assets for the last 10 years to exchange traded funds. So really, the mutual fund industry is it's not dying, it's definitely on life support. And it probably will be for the duration of mutual funds, especially as people age out, pass away, people inherit mutual funds. If they cash them in, they'll move them to ETFs or even individual stocks. So, part of that is if you're going to recommend mutual funds, you should have just partnered with Vanguard or somebody and said, hey, this is the Dave Ramsey model and invest in this ETF or something along those lines. But I guess he just doesn't want to be a real financial advisor. Obviously, he is giving advice, but he's not a licensed advisor. So he has to be careful in how he words things. I will say, though, that if you go back to early 2000s, there are a lot of misunderstandings of how exchange-traded funds, ETFs, work. And a lot of people think that there's derivatives. You don't actually own anything. And that's not the case at all. You have 1933 Act ETFs, and you have 1940 Act ETFs. You want to own the ETFs that actually own something, not the ETFs that replicate something. So if you're giving information or giving advice to the masses, it's kind of hard to teach them between 1933 and 1940 Act ETFs. So I do understand why he would say, hey, buy the mutual fund. Because if you're buying the mutual fund, you actually own something. Well, if you buy the ETF too, you actually own something. But then it's like a whole nother level of education that you have to go down when you're talking to millions of people at the same time. So the next thing he says is spread equally over 4 categories. So growth and income, aggressive growth, and international. So you'd allocate 25% to each category inside your portfolio. You know what? That's not bad advice. I think he and Vanguard are probably the only 2 companies that would ever allocate 25% to foreign right now. Under allocation to foreign over the last 2 decades has proven to be a very good strategy. Of course, that doesn't change anything about the future necessarily. So, I don't know. I was curious. So what I did was I went out and I created a model for this. I created the Russell 1000 Growth ETF to track his growth allocation. His growth and income allocation, basically growth and income is like dividends and stocks that grow. I just use the S&P 500. That's the simplest form to replicate that, I feel like. Aggressive growth, I use the S&P 600, so that's small cap stocks on the growth side. Companies that are growing fast that are smaller than your large asset classes or larger cap size. And then international, I just simply used Vanguard's all world except US. So we capture everything in the whole wide world except for US stocks for the last 25%. Now, you have to have a benchmark. You just can't put together a portfolio and say, oh yeah, I like that return. You have to have something to benchmark it. So in this case, since he doesn't recommend anyone hold bonds, we have an all 100% stock portfolio. So the ultimate test, well, it's the S&P 500, because over a long time period, 99% of people aren't going to beat the S&P 500. This is 20 plus years, your lifetime, most likely. So if we're using the S&P 500 as a benchmark, over 1 year, we'll call it the Dave Index. The Dave Index, which has, I did use ETF, so it has an average cost of 0.12% per year, which is a lot cheaper than how Dave would have you actually invest inside the mutual funds. And quite honestly, if we digged a little deeper, we could probably get that down to 3 or 4 basis points or 0.003 or 5% per year. So it'd almost be free. But anyway, over 1 year, Dave has a return of 23% versus the 28% in the S&P 500. So we go out 3 years, the Dave Index, as I call it, 78% rate of return versus 83% in the S&P 500. And then over the last decade, 10 years, the S&P's done really well. It's been hard for anyone to beat it. 354% rate of return over 10 years, where the Dave Index has a 312% rate of return. Now, to be fair, the Dave Index is not really Dave's actual individual fund choices. He doesn't give us that information. He just gives us the asset classes. So by default, I go to the lowest cost, lowest barrier to entry for an investor, which would be exchange traded funds. Plus, if you buy the mutual funds inside a brokerage account, which more than likely, if you are past all your baby steps for eliminating debt, you now are debt free. You're putting a lot of money into your retirement accounts, but also into a brokerage account. So money going into a brokerage account inside mutual funds can have a tax issue. Mutual funds generate capital gains at times that you have to pay income tax on, even though you didn't receive any money, meaning you didn't sell anything, but the fund company did sell something and you have to pay the tax bill for them. So with the exchange traded fund or the ETF, the creation redemption process, which is unique to ETFs, hides that. So you actually have some tax savings by owning the ETF versus the mutual fund. This is where I think Dave is missing the boat on saying no ETFs inside portfolios. But in the end, the reason why our Dave Index did not exceed the S&P 500 is because foreign stocks have really had headwinds over the last couple of decades. Growth stocks have done extremely well. In his case, the outperformance of growth has been offset by the underperformance in foreign investing. So if you invested this way, you had a great rate of return. You had a great 1, 3, and even a 10-year rate of return. So it's not horrible investment strategy. Now, then he gets into other areas. For example, we have a list of don't invest in. So he says, don't invest in individual stocks. Well, I can relate to that. I mean, individual stocks, you could find a Tesla, you could find a Google, you could find a lot of individual stocks that historically have done very well and made individuals very wealthy, mostly the creators of those companies. However, when you invest in individual securities, you also can go the other way, where you lose assets a lot versus the market. And you never want to be in a position where the index or the average is exceeding what your rate of return is. So for individual securities, and honestly, it's not a fair game for most individual investors today. News moves so fast and most of us are busy working. So it's really hard to figure out, when do I buy stock? When do I sell a stock? And how long do I actually intend on keeping a stock in my portfolio? In the end, no one can beat the S&P. Clearly, not even Dave. So I would focus on long-term index funds, not on single individual stocks anyway. So I understand that. And can you imagine Dave trying to tell millions of people at the same time which stocks to buy? That creates a compliance nightmare. Next thing he says, never invest in Bitcoin. I totally understand that. But not even for fun, Dave? I mean, just like maybe a little bit. I mean, even in our own podcast here, we talk about, hey, if you want to invest in cryptocurrency, don't make it anything greater than 1% of your total liquid assets. And that's just because 1%, if it does really well, is going to make a big difference in your portfolio and its rate of return. But if it goes to zero, which is probably not probable either, but it could happen, if it goes to zero, you're really not that much for the worse because of that. So Bitcoins, remember, are unregulated industry. So it's a little scary out there right now. And you should almost look at it as almost entertainment purposes, or it's for the really, really long-term investor. Whole life insurance policies, he says, don't ever invest in whole life insurance policies. I wholeheartedly agree with that. You should never buy a whole life policy for an investment. A whole life policy is a life insurance policy, and there are many applications where it applies and you should buy it. But as an investment, that's making the person who sold it to you very wealthy, and it's not growing your wealth at all. So I would stay away from people who even recommend that. They're kind of the people in our industry that are not looking out in your best interest. Annuities. Same people that sell the whole life also tend to sell the annuities. And, you know, there's people who would disagree with me, other advisors who will disagree with me, but I can tell you now, I run a fee-only fiduciary shop, and we're pretty good at math, quite honestly. We can't make the math add up for buying annuities. So I think Dave is doing our entire industry great service by reminding people to stay away from annuities, but also the annuity salesman. Bonds in a portfolio. You know, I'm trying to figure out why Dave doesn't want bonds in the portfolio. One of the things that, you know, bonds are good for is keeping us sane in times of complete mayhem. For example, you had the COVID crash of 2020. Markets are falling 30-something plus percent. If you even just had 10% or 20% bonds in the portfolio, you were not falling as much as the overall market. Maybe that helps you sleep better at night. Bonds, as far as a long-term investment, are a stretch right now because interest rates are so low. They're going to be rising, which hurts bonds. But the bottom line is we typically need to have bonds in our portfolio because most of us can't stand the volatility that the overall stock market gives us. He also says no to micro investing. So these are teeny tiny companies that you would invest in. I can agree with that because most of us don't have the knowledge enough to know about balance sheets and P&Ls and how to grow companies. So micro investing probably on your own in your own business makes sense, but maybe not in other people's businesses as well. He doesn't like REITs, ETFs, and CDs. I don't know why anybody would buy a CD now. Most high yield savings accounts have higher rates than CDs do. The real estate investment trust doesn't make much sense to me either. I think that should be a component to everyone's portfolios, carrying at least 5%, publicly traded REITs. And then obviously, I just totally disagree on the ETFs. I really feel like he researched this in the early 2000s and hasn't gone back to review it yet. But that's our 2 cents on how we think about one simple post on Instagram or Facebook or the tweet wherever you saw it. It's also in all his books and publications. And, you know, the guy's done amazing things for a lot of people. I just think we probably should skip the investing section of that and focus more on low cost, diversified investments. And then obviously our own behavior. And that's where I think financial advisors can come in to help with this. I will add that Dave does have a Smart Investor Pro network where you can reach out and talk to an advisor about getting out, I think, after baby step 4. But I will add that none of those advisors agree with this tweet or even the how to invest your money. I know several advisors in that network, and they all have REITs in there. Most of them are using all ETFs. So there's a little disconnect between the investors and obviously the main company and their investment philosophy. Hope you found this helpful. Thanks for watching. Have a great day.